Welcome to Stock Informer for you. The noise in the market is loud, but we prefer to let the data do the talking. Indian Railway Finance Corporation, or IRFC. It was once the absolute darling of the Indian stock market, rocketing to all-time highs and creating massive wealth for over 50 lakh retail investors. But today, the story looks completely different. The stock has crashed over 60% from its historical peak, losing 25% of its value in 2026 alone, and is now hovering near its 52-week low at around 91 rupees. What exactly is going wrong with this railway monopoly? Is this a falling knife you should avoid, or is the recent government offer for sale providing you the ultimate discounted entry point of a lifetime? In this video, we are breaking down the brand new IRFC 2.0 business strategy, the freshly released FY26 financial scorecard, the secret behind the latest conference call, and a brutal valuation reality check. Let's look at the raw facts, the big pivot. What is IRFC 2.0? To understand IRFC's future, you have to understand its massive structural shift. Historically, IRFC had a very rigid business model. Borrow money cheaply, buy trains and tracks, and lease them back to the Ministry of Railways. It was a single client, low margin, zero risk business. But welcome to IRFC 2.0. The company is aggressively breaking out of its railway-only shell to become a diversified infrastructure powerhouse. In the financial year 2026, IRFC completely smashed expectations by executing a monumental 72,949 crore rupees in non-railway agreements. Where is this money going? Nearly 60% of these new sanctions are targeting high-yield power and renewable energy transmission grids, followed by massive allocations to core sectors like fertilizers and urban mega-metro projects, including the DMRC and MMRDA. They are transitioning from a slow-moving utility into a highly competitive infrastructure financier. The financial scorecard and the earnings call secrets. Let's talk numbers. IRFC just wrapped up its full-year FY26 earnings, and the balance sheet has crossed a historic milestone, bursting past the 5 lakh crore rupees total asset mark. Full-year net profit came in at an all-time high of 7,009 crore rupees, growing 7.8% year-on-year. Even better for dividend lovers. Management actively stepped up their annual dividend payout to 2 rupees and 10 paise per share, a massive 31% increase over last year, locking in a very comfortable forward dividend yield of around 2.3% to 2.5%. But wait, if the annual numbers are great, why did the recent Q4 net profit look flat? In the latest earnings conference call, management cleared the air. The sequential dip wasn't because of bad loans or default stress. IRFC still proudly maintains a flawless 0.00% net NPA ratio. The minor hit came from a regulatory technicality. New RBI compliance guidelines require upfront standard asset provisioning for their brand new non-railway commercial loans. Management explicitly set aside 50 crores for this, proving that the underlying core engine is still completely healthy. The 90-day news flash, the OFS drama explained. So, if the financials are solid, why is the stock bleeding right now? The answer lies entirely in a short-term regulatory bottleneck. Over the past 90 days, the news cycle has been completely dominated by the government's relentless drive to meet SEBI's 75% maximum promoter holding rule. Just this week, the government launched a fresh offer for sale, OFS, to dilute another 2% stake, setting a discounted floor price of 91 rupees per share. This created an immediate arbitrage drag, pulling the market price down. But here is the silver lining. While retail investors are panicking, the big institutional players are buying the dip. The institutional portion of this June OFS was oversubscribed 1.86 times on day one alone, showing that big funds are eagerly vacuuming up these shares the moment they get cheap. Valuation reality check, cheap or trap? Now let's do a brutal valuation reality check. At a market price of approximately 92 rupees, IRFC is trading at a trailing PE ratio of 17.15, well below its 5-year historical average of 19.4 times. The froth from the 2024 railway hype is officially gone, but is it the cheapest stock in its sector? Not exactly. if we compare it to power infrastructure peers like PFC or REC Ltd, which trade at dirt cheap PE multiples of 6 to 7 times and price to book values close to 1.2 times. IRFC still commands a visible premium with its PB ratio at 2.12 times. Why does the market give IRFC this premium? Because of asset safety, PFC and REC carry credit risks linked to state electricity distribution companies. IRFC carries zero credit risk because its ultimate backup borrower is the sovereign government. You are paying a premium for bulletproof safety. The bottom line? The short-term picture for IRFC will remain volatile until the government's supply overhang completely clears out. But looking at the future, with a clear roadmap to expand its net interest margins through IRFC 2.0, robust institutional demand at 91 rupees, and a steadily growing dividend yield, this correction has stripped away the risk and restored core value. Major brokerage houses maintain a 12-month target of 110 rupees to 120 rupees, implying a structural 20% to 30% upside potential from these levels. Are you bidding for the retail OFS shares, or are you waiting for the technical downtrend to completely reverse? Let me know your strategy in the comments below. Don't forget to like this video, share it with your fellow investors, and hit that subscribe button for more data-driven market breakdowns. See you in the next one.